My name is Jake, welcome to the channel. In today's video, I want to talk about dividend growth rates and time horizon. There were 4 companies here, dividend companies that just increased their dividend. And as we all know, every dividend investor has a different time horizon. In this video, I'm going to share with you how you can assess a company, a business, a dividend company, if it's the right investment choice or vehicle for you based off of your time horizon. And as we all know, your age isn't really an indicator of how you should necessarily be investing. It's rather when you plan on living off of the dividend income from your investments. This is very different than, how we were traditionally taught, or how I personally grew up thinking, okay, I'm going to go and I'm going to enter the workforce. I'm going to, be part of the machine and work until I'm 65. And then maybe I'll go travel later on in life, right? Or maybe I'll enjoy retirement later in life. That's not what I'm talking about here in this video. This is not what I talk about on my channel. I follow the FIRE movement, the Financial Independence Retire Early movement, and I'm looking to retire in the next 1 to 2 years at the age of around 38. So that's kind of where I'm at. And I've watched a lot of YouTube videos on finance, personal finance, investing. My favorite videos were those videos where the person talking and sharing the information helped me implement or put into action what was being discussed on the video. Now, let's be honest, there's a ton of great videos out there on YouTube, but a lot of them, they're just informative and you consume the content and then you forget it and you never implement it. This video is not one of those. I want to help give you the tools to be able to implement what I'm talking about in this video so that you can go do it with your own portfolio. So whatever your age is, whatever your time horizon is, my hope is with this video, you're able to follow along and then go and implement this with your own portfolio. If you're just a pure growth investor, you're feeling the pain. And not just growth investors, but all investors, right? The whole market is down. And I'm looking at this like the Dow Jones dropped nearly 1,000 points in one day. S&P dropped almost 3%. Like, this is massive movement in the market. And there's a lot of stuff going on, right? And so if you have a short-term mindset, this is really scary. If you have a long-term mindset, as long as the company is cash flow positive and continuing to grow, this is a great opportunity to average down in your portfolio, especially if you're dollar cost averaging. But what I will say is, every time I look at the stock market, every single day it feels like the market is down and it's going lower and lower. And I just keep asking myself, how low can it go? And it kind of looks a little like this.
That's not bad. But check this out. Go. Oh! Any more? That's it, but that's pretty wide, right? Yeah. I can go lower.
Oh my gosh, I love that show. One of my favorite shows of all time. All right, cool. So let's take a look at some companies here, and I'm going to walk everybody through this, and my goal is to walk you step by step so that you can do this on your own. Okay. Coca-Cola just raised its dividend by nearly 5%. This was back in February of 17. Proctor Gamble here April 12th just raised its dividend by 5%. That's a good dividend increase for Procter & Gamble. Now, when you compare it to inflation, it kind of looks not so great, but I think over the long term, a 5% dividend increase for Procter & Gamble is respectable. Johnson & Johnson just here this last week raised its dividend by 6.6%. Pretty dang good dividend raise from Johnson & Johnson based off of historical data. Costco just raised its dividend by nearly 14%. 14% is blowing inflation out of the park. Well, today, who knows what tomorrow will look like. But for now, Costco is beating inflation. They just raised it here April 13th. So what I'm getting at is all 4 of these businesses, they're all different. Right? They're dividend companies, right? They're, when you think about Procter & Gamble, Coca-Cola, Johnson & Johnson, those are your legacy, dividend growers. Costco is an up and coming, it's raised its dividend for about 17 years. It's not a dividend aristocrat. It's more skewed towards growth. The starting dividend yield is a bit lower. So what we're trying to understand is, if you have a long-term time horizon, how long is it going to take you to generate X amount of dividend income in the future. So now what I want to do is I want to analyze Coca-Cola, Procter Gamble, Johnson & Johnson, and Costco using a dividend reinvestment calculator. And so what I want to do is I want to understand, okay, if I have an initial investment and if I'm dollar cost averaging, what is the expected return that I could, what is the return that I could reasonably expect based off of historical data? But I want to be very clear that historical returns are never a guarantee of future returns, but they're a great way to kind of forecast using historical data to what you could potentially or reasonably assume in the future if you were to invest into an investment like Coca-Cola, Procter Gamble, Johnson & Johnson, or Costco. And so what we're going to do is we're going to input the data into the dividend reinvestment calculator. And if you want to follow along, you can use the dividend reinvestment calculator. The link is in the description below. All you have to do is make a copy. In order to make a copy, you go over here to File, make a copy, and then you can save it to your G drive. But the key thing here is that you make a copy, otherwise you're not going to be able to edit the document. And as you can see here, there is an anonymous camel already in this document as well. So this is a public document. No one can edit it unless you make a copy. This is my master file here that I have. But essentially what we want to do is we want to understand, based off of your individual inputs and these four companies, what is the estimated dividend income over time. All right, now when we're looking at the dividend reinvestment calculator, it's important that we talk about a few assumptions, because if we want to make this as realistic as possible, there have to be some assumptions. So first off, we're not including inflation. So inflation historically has been right around 2%, and I'm sure there's going to be some smart ass in the comments saying, well, Jake, inflation's 8.5%. How does this work? So yes, inflation is 8.5%. Calm down. Over the long term, we're talking decades here, the average is around 2%. So the Fed is targeting a 2% rate, and that's what we're going to go with. This is also not including taxes. Taxes are a massive factor when it comes to your total return, but we're not including those in this assumption. The growth rates, we're assuming that these will continue based off of historical data. And once again, for the second time, because I always get somebody in the comments saying, well, Jake, historical returns. Yes, I know historical returns are never a guarantee of future returns, but we're going to use historical data to project these. Okay, so take it with a grain of salt. It's not 100%, but to make it reasonable, we're going to use historical data. The numbers, we're going to look back 10 years from January 1st, 2012, and we're starting with a portfolio value of $100,000, and we're going to be dollar cost averaging $2,000 a month. Now, this you can plug and play whatever your numbers are. If you have $1 million, if you have $5, right, or whatever it is, use your numbers, okay? But for the video here, we're going to use these. We're going to assume that you're reinvesting the dividends. We're going to assume that we're analyzing today's prices. So if you watch this video a month from now, understand that the prices are going to go up and down. They change every day. So we're using today's prices, and we're assuming that you're a buy and hold investor and you never plan on selling, and you're reinvesting the dividend. So you're not rebalancing, you're just dollar cost averaging, and you never sell. Okay, those are the assumptions. So when we're looking at the calculator here, these are the assumptions. All right, now when you're using the calculator, I want to walk you through how to use this. The only fields that you have to update are in yellow. Okay, everything else, the calculator will work for you. All right, and so when you're downloading this, or when you're clicking on the link, you're not going to be able to change it. You're going to have to make a copy, right? And so as you can see, there's two people. You got the camel and you got the hyena. That's probably my wife. She's probably in here. So that's her. Yeah, so the initial investment, that is your investment. It could be $5, it could be $1 million. I don't care. Just put in whatever number you have there. Annual deposit, that's what you're investing on a regular basis, on an annual basis. Okay. This calculator is not sophisticated enough to do it monthly. So just bear that in mind. The capital appreciation of the investment, the dividend growth, and the current yield. So you might be asking yourself, well, Jake, I don't know how to get these numbers, and I'm going to show you exactly how to do that. Okay, and I have details in the description here, so if you can't follow along or you get confused at any point, you can reference the notes at the bottom here. So here's how I explain how you can do it. Okay, now let's use this. These numbers right here, this 3.83, this 5.88, 270, these are the actual numbers today for Coca-Cola, and I'm going to show you how I got these numbers. All right, so to begin, we're going to understand what is the total annual return of Coca-Cola. Once again, this link is in the dividend calculator. So if you want this link, you can go in the dividend calculator. To gather the data for Coca-Cola, we're going to look at the ticker Coca-Cola. The starting date is January 2012. This is what we want to look at. This annual return, this percentage, this is the number that we want. So what we're going to do is we're going to take out our fancy calculator, and we're going to do 9.71. So remember that this is 9.71%. And then what we're going to do is we're going to go over to Seeking Alpha. We're going to type in Coca-Cola. We're going to go under dividends and dividend growth. And so what we want is we want the dividend growth rate. So dividend growth rate 10-year CAGR. CAGR stands for compounded annual dividend growth. And what we want to look at is this right here. So Coca-Cola has a dividend growth rate of 5.88% over the last 10 years. This is annual, right? Annualized. So what we want to do is we want to subtract the 9.71, subtract 588, and that's going to give us a whopping 3.83% for the capital appreciation of Coca-Cola. So not super crazy, not really high, but that is Coca-Cola. And so what we're going to do is we're going to go over here, and that is where we get the 3.83. That is where you see the capital appreciation. The dividend growth is the 5.88. Remember right here, 5.88. All right. And then if we go back to the calculator here, the current yield, how we get the current yield, what I like doing is just go to dividend scorecard. This is the dividend yield forward looking. So over the next 12 months, it's 2.7%. And so we're going to put in 2.7%. And that is how you do it for every company. Okay. Now, if you have an ETF, I have a link to how you can capture that for an ETF. Okay. But we're just going to focus on stocks for now. So these are the numbers for Coca-Cola. So what you can see is after, let's take a look at the appreciation here for a second. So over the next 10 years, in 10 years, if you've invested $100,000 and you're investing $2,000 a month, you're going to have over $500,000 in your portfolio, right? And this is going to give you a annual dividends of $16,000. Now here, this is something that you want to see. After 30 years, you'll have a dividend portfolio of $3.5 million and just under $160,000 in earned dividends. Pretty cool. Let's see what that looks like on the chart here. Okay, so dividends over time, as you can see, you're still dollar cost averaging, right? So the portfolio is still growing, it's growing. So now what we want to do is we want to analyze and see how long is it going to take you to generate $75,000 with those assumptions. It's going to take you just around 24, 23 years to generate $75,000 in dividend income. All right, now let's take a look at the exact same thing, but with Procter Gamble. And because you are all rock stars and you all know how to do this, I'm not going to show you each individual step for each individual company. You already know how to do that. You're already smarter than you were 5 minutes ago. Okay, so after 10 years, you're going to have over $600,000 in your portfolio value with the same assumption. So you're going to have more in your portfolio value with Procter Gamble than with Coca-Cola. After 30 years, you're going to have just about $4.5 million in your portfolio. But here's the crazy thing. You look at this, the dividend income is actually really low. The dividend income is low. And so you might be scratching your head and thinking to yourself, well, how is that possible? Why is that the case? The reason why is Procter & Gamble is really pricey right now. You look at the price of Procter & Gamble, it is yielding just over 2%. This is pretty low. Procter & Gamble, at 2.25 dividend yield, starting dividend yield, that is not a steal. That is really, really pricey. This is where we have to take it with a grain of salt because Procter & Gamble is pretty pricey. And when you run a simulation like this is where it gets a little funky. I don't believe that this is necessarily going to continue because I don't believe that Procter & Gamble is going to be trading at a premium over the next 30 years. So that is where this calculator is a little bit, you got to take it with a grain of salt. If we look at this the exact same way, if you were to invest into Procter & Gamble, and if it were to continue down its path, which is unlikely, it's going to take you significantly longer if Procter & Gamble keeps up at this rate, which I don't think it will, but this is the rate at what this is the growth that you're looking with a company like Procter & Gamble. Your share price is higher than Coca-Cola, but your dividend income is significantly lower. Okay, so how long is it going to take you to generate $75,000 in dividend income? Well, it's probably going to take you about 35 years. So if you're 20 years old and you want to retire off of your dividend income and you have a long-term time horizon, Procter & Gamble might not be the very best option for the long-term time horizon. So if you still want to get exposure to Procter & Gamble, yeah, that's great. But maybe you limit your exposure to Procter & Gamble based off of the numbers here. So that's just one example here that you want to be careful of. But once again, I want to overemphasize the numbers here. This is off of today's price, and I don't necessarily think this is going to continue on a regular basis for the next 30 years. But that's the beautiful thing about the future. No one knows, but those are the numbers as they stand today. All right, now let's take a look at Johnson & Johnson. Same process, different numbers. We have a little bit more capital appreciation with Johnson & Johnson, a little bit more dividend growth, and a little bit of a higher dividend yield. After 10 years, your portfolio value is going to be over $600,000, so a bit more. And over 30 years, your portfolio value is going to be just around $5 million. And look at this, your yearly dividend income earned is going to be higher than with Procter & Gamble. So what is that going to look like here, over the long term? As you can see, the magic number that we're looking for is $75,000. So how long is it going to take you to generate $75,000? It's going to take you just around 27 years. If you were to invest with the numbers, if they were to continue into the future as they stand today with Johnson & Johnson, it would take you roughly 27 years to generate $75,000 in annual dividend income. All right, now let's take a look at Costco. Same exact process. You can see that the capital appreciation is significantly higher with Costco. The dividend growth also significantly higher, but the current yield, this is much lower than the others. So let's take a look and let's see what we have here. If you were to have $100,000 invested and you were investing $2,000 a month, in 10 years, you would have around $700,000 in your portfolio and you'd be generating just under $5,000 in dividend income. Not so great on the dividend income, but great on the portfolio value. Now let's take a look after 30 years. After 30 years, you'd almost have $9 million in your portfolio, but your portfolio would only be yielding right around $76,000. So that is massive. You have this massive portfolio, but the dividend income is going to be pretty, it's going to be lower, but it's going to be compounding much faster. So let's take a look and let's see what that looks like. So if you were to do this, if you were to invest into an investment like Costco, it would take you 30 years to generate $75,000 in dividend income. But here's the kicker, everybody. You're going to have around a $9 million portfolio. I don't know about you, but I could do a lot with $9 million. But the key thing here is you notice this, that the jumps. Every year, you're going to get $10,000 and more over time. So as the portfolio continues to compound, your wealth is going to snowball. Everybody watching this video, you probably have heard of the snowball effect. This is the snowball effect, where you see this, it starts off very, very slow. It's very slow, but then it really starts to take up speed, and then it's going to compound. And once you get into these numbers over here, it's hard for my brain to even comprehend the growth that comes with that. And then you start looking in the hundreds of thousands, and then over decades, you're talking hundreds and even not millions of dollars, which is hard for my little brain to comprehend, given that from humble beginnings. I don't know, but it's just hard for me to comprehend that. But that is the math. All right. So you have to kind of understand, okay, you're not going to be generating as much dividend income for, years and years. But here's the thing. If this isn't a taxable account, that's not the worst thing in the world, right? Because in a taxable account, you don't want to pay a lot of dividend taxes as you're still working, right? You don't want that unnecessary tax burden. But once you say, okay, all right, I'm going to retire or work less, that's when you're going to be making more in dividend income. You're going to have less income to pay taxes on from your day job. And that's where your dividend income is going to start picking up the slack. And then once you can eventually fully transition from your active income to your passive income in retirement. So if we take a look at all four of these companies, CocaCola, Johnson & Johnson, Costco, and Proctor Gamble, every one of these investments is growing at a different rate. Coca-Cola, in this case, based off of today's numbers, now this could change a week from now, a month from now, a year from now, but off of today's numbers, Coca-Cola is the clear winner if you want to retire sooner off of your dividend income. And as we mentioned, going back to these assumptions, if these assumptions meet what you're looking for, and this is, something that you could, wrap your head around and be like, yeah, that makes complete sense. I never want to sell. I want to reinvest my dividends. I'm going to dollar cost average, blah, blah, blah. But if you were to stack rank these, Coca-Cola would be the winner if your goal is to generate $75,000 and never sell your shares, right? Using the assumptions above. Johnson & Johnson in second place with 27 years, Costco with 30 years, and Procter & Gamble with 35 years. I was actually very shocked by this, with the Procter & Gamble being 35 years. Everybody, I would take this with a really big grain of salt. I don't necessarily think that this is going to hold up. It's just because it's trading at such a high valuation today. So, and I don't necessarily consider that normal. But what I think is really interesting is when you're looking at your investment strategy, and if you've decided, hey, I want to buy and hold, I want to average in, I want a dollar cost average, this is the kind of stuff that you want to start playing around with. So I hope that this was helpful. If you're a new dividend investor or if you're a experienced investor, I would highly recommend playing around with a dividend calculator like this. And you can either do it for your individual companies, right? If you have, just a few ETFs, or if you have, a handful of dividend stocks, or if you want to do it for your entire portfolio. So my portfolio is yielding, it has a capital appreciation rate of about 6%. It's between 5 and 6%. The dividend growth is around 5 and 6%. And my portfolio yields about just over 5%. And if you look at my portfolio, this is how it would look for the entire portfolio. This is how my portfolio is compounding and growing. And so it would take about, 16, 17 years before my portfolio as it stands today were to, reach $75,000, right? And that's, using these assumptions right here. What it's not assuming is the tax implication. So my portfolio is not 100% skewed towards tax efficiency. So don't look at this as just free gains and, the most tax efficient, because I have REITs in there and I have covered call ETFs in there. So that does impact the return, the total return. So that's something to be very aware of. But once my wife and I, when we retire, the portfolio is still growing. And if you want to use this calculator, this is a cool thing. So if you go to this tab, living off of your portfolio today, right? And let's say my wife and I, we were to retire. I think we have, let me see, 1, 2, 3. If I'm doing the math right, this is not include. If we were to sell our house, it'd be right around $2 million. But let's say we were to retire tomorrow and we had reached, fat fire. Right now we're at lean fire, but let's assume we reach our goal. Our portfolio is still growing at about 6%. The dividend growth rate is about 6%, and the dividend portfolio is yielding about 5%. But the thing that you'll notice here is the shares owned, right? This calculator, don't let this confuse you. All this means is that we're not reinvesting the dividend and we're not adding additional shares, okay? So if we were to live off of the portfolio, once we reach fire, our portfolio is still growing. You see this? It's growing a little bit slower because we're not reinvesting the dividend and we're not investing additional money each month, or we're not dollar cost averaging, but you can see that the portfolio is still compounding and still growing. And so in 10 years, we're going to be making almost, how long is it going to take for it to double? It's going to take about 13 years for the dividend income to double. Isn't that crazy? When I showed this to my wife and she was like, wait, are you sure? I'm like, well, I mean, it's never a guarantee, but that's what the math says. This is what gets me the most excited. When I think about it, every single year, I'm going to get a pay raise, right? And I'm going to get a pay raise of about 6%, and it's going to continue to grow over time. And I'm thinking once we reach the age of 60, right around here, in our taxable account, we'll be getting over $300,000 in annual dividend income, in addition to our Roth IRA that we have, right? So, and our HSA and all that good stuff. This is how you build generational wealth. And this is how my wife and I are doing it. And I want to throw out that disclaimer. This is not the only way to do it. And this is never a guarantee. And when you look at this, if you're following along at home and you're watching this video, I would encourage you, download the dividend reinvestment calculator, play around with the numbers. You know, you can see this, look at this, a coyote, an anonymous coyote, a hyena, aka my wife, and the camel are doing this. So you can do this as well. I don't charge any money for this. This is a free calculator. I'm not going to make you sign up to a Patreon or give me money to use this. This gets me really excited. I hope that it gets you excited. Dividend investing, you know, it's really just math. It's simple math that you can use to your advantage to pick the right investment vehicle to help you get to the destination that you're looking to get to, or the goal or the outcome that you're looking for. I hope that this was helpful, everybody. I hope that you learned something new. Thank you so much for watching, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.